Recording in progress.
Good evening, everyone, and a warm welcome to today's edition of Your Market Navigator Expert Series. The key agenda for today's discussion is to introduce to you our new product offering on the fixed income side, which is ABSL Long Duration Fund, and to discuss the prospects of this proposition or this new fund in the current macro policy and also the economic backdrop. At the same time, to understand in details what are the key features, the rationale for launching this fund at this point in time. Just to quickly take you through what a long duration fund is. It is an open-ended debt fund, a fixed income scheme, which shall invest in long maturity government bonds, which is sovereign papers, or AAA PSU or corporate bonds, such that the overall duration of the portfolio is 7 years and above at all points in time. So to discuss this proposition in details, I have with me the fund managers for this fund, which is Mr. Harshil Suvarnkar and Mr. Bhupesh Bameta. And a warm welcome to both of you all. So without much delay, let me begin this session today by asking a couple of questions to both Harshil and Bhupesh about this fund. And then, of course, we'll be happy to, take your views, your questions to take this discussion further. So, Bhupesh, my first question will be to you. I of course introduced what long duration fund is, but what is the value proposition for this fund within the category that it is, and what is the type of investors who should consider this fund according to you?
Okay, so in fixed income space, we have a variety of offering for our investors. There are investors who will be looking for higher carry. There will be investors who are invested for short term. There are some will be wishing to invest for 1 to 3 years, and there will be some investors who will be looking to invest for a longer term time frame. Now, this specific fund is a long duration fund. It's a SEBI category under which the minimum Macaulay duration has to be 7 years. So it's a long duration, long maturity product. Now, what happens now in Indian fixed income market, there is a decent spread that you get between, in investing in a short-term product, short maturity product versus investing in the long maturity product. Now, because this has mandated to be investing in at least 7 year plus, therefore, it's obviously a long duration product. And what we target, what we are trying to give investors via this fund is an exposure to the high term spread that we typically get in investing in a longer duration product vis-a-vis investing in a shorter duration product. So here you'll be getting a decent amount of term spread. Now, typically, the general term spread that you get between a repo rate, overnight rate, and a 14-year portfolio would be maybe 120 basis points around those levels. Currently, the spread that you are getting is significantly higher. Repo rate is trading at around repo rate is at 4.9%. The longer term 10-year, 14-year bond will be at around maybe 760. So the spread that you're getting is significantly higher than you typically get on a normal situation. Plus, generally, these spreads remain elevated. You do get a lot of term spread. So if you are staying here for a long-term time period, you will benefit from this elevated term spread, and that will reflect in your returns. Now, the drawback of this higher duration strategy, as it is in any higher duration strategy, is that its duration is higher, and as we know, duration is the interest rate risk. So, because the duration is higher, it will be subject to higher volatility. Therefore, who it is suitable for? It is suitable for those investors who are willing to take this higher level of volatility in order to gain from the higher term spread, which longer duration brings in. So, we are advising, we are saying that investors who have a horizon of at least 3 to 5 years, or probably more, maybe it's 5, 10, 15 years, they should do, they would be much better off in investing in such a strategy. But we have, in our tests and all, back testing, and also analysis of Indian market and global market, what we have seen is that generally, so how do we measure whether the extra spread is compensating for the higher duration risk that you are taking? For that, we have a measure in finances which is called the Sharpe ratio, which tells you what is the excess return that you are getting vis-a-vis the level of excess volatility that you are getting. So generally, higher the return, obviously better for the investor. Higher the volatility, worse for the investor. So let's have a ratio of the two, whether whether the higher return that you are getting and the respective volatility that you are getting, whether the higher return is compensating for the higher volatility. And here what we find, as you can see in the slide, is that the Sharpe ratio of this 14-year bond, which is the general level, basically it's a representative of higher duration GSEC portfolio, is significantly higher than most other asset classes, and it is even higher than presentation mode, and it is even higher than a Nifty. It is better than even an equity return that you'll be getting if you are invested in such a long duration portfolio. Yes, so net, the value proposition of this fund is for those investors who are, who wants to invest in a longer duration portfolio, who are willing to invest for longer time frame in order to get benefit out of the extra term spread that you are getting in a decent portfolio, which is, this is going to be a very blue-blooded portfolio, GSECs, SDLs, and some amount of highly rated corporate bonds. So it's going to be a very good credit portfolio, predominantly GSECs and SDLs. And it will also benefit from the higher term spread. What we also propose to do is that given the supply, sometimes spreads in one segment goes up and other segment goes down. So we'll be tactically allocating the funds into these three segments: GSEC, SDL, and corporate bond, in order to benefit from the higher spreads in the respective portfolio. But the credit quality will be very blue-blooded, so there's no issue on that. That's broadly the value proposition for this fund.
Sure, Bhupesh. So what I hear you saying is a couple of advantages of this proposition: investing largely in sovereign and AAA rated securities. Of course, the credit risk is negligible, or rather, if I can even take the liberty to say next to zero.
It's called gilt. That's the reason why GSEC and SDL are called gilt, because they are virtually credit risk free. Right.
So the credit risk is technically zero in this fund. And because the fund is going to have a relatively higher duration, of course, longer the duration in a normal yield curve scenario, higher is the yield. So that is the sort of, higher term spread like you defined. So that's the other benefit that comes through. And possibly for the higher volatility that would come with the higher duration, I think staying invested for a longer period of time sort of, helps one tide through that volatility or those cycles, right?
Yes. Yeah.
So just to take the discussion forward, maybe, you could throw some light on, the current macro, both domestic and global macro scenario. And in that backdrop, the conduciveness of, a product like this.
Yeah. So, as we know very well, most of our investors will be knowing this, that over the last few quarters, inflation has become the key theme. And because of which the central banks had to hike, has turned very much hawkish pretty much across the board. Plus, we are also having the Russia-Ukraine war, and COVID is still not over from China. So a lot of, we had this COVID crisis in 2020, after which central banks and policymakers came out with a lot of stimulus, after which, there was a big jump in global growth and global markets, equity markets, bond market, commodity market, everything rallied. But, that also brought in inflation, and now central banks are on the forefront trying to fight this inflation. And because of that, because of very aggressive central bank language, because of the very strong anti-inflation posture, and also because of Russia-Ukraine war plus COVID impact of China, and naturally you can't have this very high growth for long. So there's a natural slowdown happening because of this, all these factors combined. So global growth, after surging very high in 2021, is steadily looking worse in larger economies, particularly US. because of very aggressive central bank tightening and expectation of very aggressive central bank tightening. Markets are in a tailspin, especially equity markets. They are falling sharply. Plus, if you look into high frequency indicator of growth, that is falling pretty sharply. As a result of that, commodity prices pretty much across the board are falling. Dr. Copper is significantly down. Iron, ferrous, non-ferrous, even crude has also started reacting to this global slowdown. Now, all these things combined, so slower growth, plus aggressive central bank tightening, plus market already factoring in a very, very aggressive central bank tightening, so which is already technically in the price, in a backdrop, where the odds of recession are going up. Many investors, I think there's recently been a survey from Bank of America that say that majority of investors are now thinking that a recession is just around the corner. So in this backdrop, longer dated bond yields after spiking early part of the year have already started going down from their recent highs. However, shorter term yields are still high because people are factoring in that there will be a lot more central bank tightening. Now, the combine these two, which means that yield curve in many, in US in particular, has already inverted, because people are, so whenever you feel that a recession is coming or global growth or in any specific economy, growth is turning down, typically longer duration does better. And last few quarters, it has already gone up, and now it is from there is gradually coming down. In India also, RBI has turned quite hawkish in the last few months because of high inflation in India, because of which markets are already factoring in a lot of aggressive RBI rate hike cycle. So a lot of this rate hike is already factored by the market, is already in the price. Markets are already factoring in that repo rate is going to go up to 680 in the next 1 year. So 190 basis point of rate hike is already factored in the market. So it's already in the price of the bond deal that you are getting. Plus, in the last 3 months, inflation, after surprising very highly in the previous quarters, this quarter, the actual inflation has come better than what RBI was expecting. It has come better than what majority of the street was expecting. So inflation has started, surprising somewhat on the positive side. Our sense is that the worst of inflation fear is behind us. And a lot of hawkishness is already in the price. Plus, if there's a global commodity price slide, it is going to have a positive impact in India's inflation as well. Plus, as I already mentioned, our yields is already, the spread of yield is already quite high with respect to repo. So I think our sense is that in this backdrop of slowing global growth, plus, inflation worries, somewhat moderating, plus a lot of hawkishness by the central bank already factored into the price. Our sense is that it gives a very decent backdrop for us to launch this NFO. We got permission from SEBI for this, even last year actually, but we waited for the opportune time for putting, for starting this fund. And our sense is that given the global backdrop, given the domestic backdrop, I think our sense is that this is a very opportune time for us to to launch this fund for our investors. And I think it's a very good time for investors as well to start allocating their capital to such a portfolio. Generally, also, we have seen in our we have done some analysis on this, and what we have seen is that whenever you invest in long duration funds where rates are between 7.5% to 8%, as it is currently, the returns that you get, as this slide shows you, is significantly better than the competing return that you'd be getting had you invested maybe in a 3-year portfolio or or in other competing asset classes. So at these level, the level of insurance that you are getting because of high term spread is pretty decent, and historically this has given pretty decent returns, provided you are willing to stay here for long term.
Sure, Bhupesh. So a follow-up question that I have here is that you mentioned a couple of points while you were talking about this, is that very steep rate hike cycle is priced in most of the curves, 190 bips, as much as 190 bips sort of. So when you say priced in, and when we talk about hawkishness of central bank, which means that we've had 2 rounds of rate hikes and we could have possibly another few, then when the rate hikes actually happens, the impact on yields actually may not pan out. When we say if it's priced in, that's
exactly.
the result.
Just see the example of last policy. The last policy, we had a 50 basis point rate hike, one of the higher side of rate hike by RBI. And still after the rate hike, there was a big rally in bonds. So bond yield actually fell after the rate hike because market was already factoring that this much rate hike will happen. In fact, market was worried somewhat higher can happen. So when even there was a 50 basis point rate hike, actually the yields fell. So that's what what we call as what is already priced in the market. The market already thinks. So I just give another example. So typically the spread that you get between a 14-year bond and a repo is around 100, 120 basis point. Currently, the yield that you're getting in this is around 760. So if we just do an average of the past many cycles from 760, you reduce. I mean, you subtract 110, 120 basis point, you get a repo rate of 640. Broadly. So the current deals are in a way already reflecting repo rate at 640, which actually is currently 490. So this much of rate hike is already there in the long end of the yield curve. You can also see this, the spreads, which we are getting here. In the right chart, you can see the spreads are already at a very elevated levels. And from these levels, of spreads, generally you tend to benefit given this extra term spread that you are getting. Also if you look into longer term time frame, yields have already gone up to 7.7% in an annualized basis. So yields are already very high, and generally, as the economy is mature, as per capita income goes up, generally, these yields generally tend to trend down only. So for those investors who are willing to stay for like 8 years, 10 years, 12 years, most likely going ahead, the yield that you'll be receiving will be much lower than the yield that you are getting right now. So it's better to lock in the gains at current level of yields rather than wait and do that later on. So in all these sense, I think our team senses that this is a very opportune time for investors to start allocating their money because most risks are priced in. Probably, as commodity prices are falling, as global recession is looming, especially in large economies. I think our sense is that this portfolio for longer investors who are willing to stay long, I think they should do quite good.
Sure. So Bhupesh, what would be your guidance on the policy normalization path of central government going forward, and what is your sort of your view on the rate hike cycle since that has already begun? Yeah.
So okay. Point to note is that our inflation is different from the inflation that is there in US and Eurozone, where we have a very high demand-driven inflation in US, where actual demand is very high. Real goods demand, you look into, it's like 10% above pre-COVID trend, which is a very high number. And wages are very high in US. Unemployment level is at rock bottom level. So in US, there's a clear case of overheating of the economy, which is resulting in a very, very aggressive rate hike cycle by US Fed. In India, on the contrary, the inflation that we are seeing is mostly an imported inflation. Inflation which is coming because of higher global commodity prices, inflation which is coming because of weaker global supply chains, and which is there because of all these COVID, pandemic related issues globally, not specific to India. Our demand levels are still quite weak. The level of growth that we are getting is still like 8-9% below the pre-COVID trend. So we are, unlike US, which is getting like significantly above trend growth, in India, our growth is still significantly below trend. Our inflation is not demand driven, it is supply driven. And that's also linked to global supply chains. Given this backdrop and given RBI's, stated view on the same, it appears to us that RBI will be guided more by what is happening domestically than by what is happening globally. So in that sense, our sense is that, so we had this before COVID, we had rates of 5.15 was the repo rate. Then came COVID, RBI came out with aggressive rate cut cycle. It brought in effective rate to 3.35. Now, the first stage, what we are seeing is this unwinding of this extraordinary monetary stimulus which they had given. So they will quickly bring rates closer to 5.25 levels, which is the pre-COVID level. Beyond that, our sense is that the rate hike cycle will be much more gradual. Our base case is that the terminal rate for this cycle should be somewhere. Our team's median estimate will be around 6.25, maybe 6.5 at the worst case. That's our base view as of now. So from 490, we think that rate can go up to broadly centering around 6%, maybe 25, 50 basis point here and there. Which again, at this current level of, longer end bond yield, which is at 760, provide the decent. So all this rate hike cycle is already, priced in this current longer end yield curve. So unless there's a very nasty surprise, we don't see very big spikes happening here. And even in that case, while it's a long duration portfolio and it is subjected to some volatility, as we had seen, if you stay here for long, we have shown one of this chart that if you stay here for 3 years at least, these volatility does even out, and you end up getting a decent returns, which basically reflect the extra term spread that you get if you are invested in such a long duration portfolio.
Sure. So, Bhupesh, a common understanding and concern that, possibly investors have in a scenario like this, where interest rates have upward biases, that how much possibly, they may rise further, they may harden more from here. And especially in a backdrop where if you look at, GSEC yields over the last 10 years or so, we've had phases when it's crossed 9%, when it's crossed 8%. Okay. So, how would you like to, that, and I'm sure because, these are different macro scenarios, that was the different variables were different at that point in time. And like you are mentioning here that the overall view that we have is possibly, long-term yields are peaking out at these levels. So how would you like to, put this whole picture together that, that sort of an yield possibly in this regime may not turn out to be a reality, and hence your case that yields are peaking out here?
Yeah, few things here. First, as I just mentioned, India's inflation is supply driven by global factors, and mostly factors driven by pandemic and the war. That's point number one. Point number two, because it's supply driven inflation, so RBI need not be in the front foot to deal with the inflation. They just need to ensure that the inflation doesn't cause financial instability. And that's what their strategy has been. That's point number two. Thirdly, in most cases, in emerging markets, you see high inflation only when the fiscal misbehaves, when the fiscal deficit becomes very aggressive, or when the government is on spending spree. What we have seen in this regime has been that, fiscally, the government has been as prudent as it can possibly be given the situation. They are, in last regime, in the UPA, when widespread belief amongst policymakers, amongst economists, even amongst politicians, is that one big reason why the previous regime lost election was because in that regime, we had very high inflation. So because of that, we had this inflation targeting framework by RBI. The previous regime itself started this inflation targeting. We have this Urjit Patel committee report. So inflation came out to be the clear focus. The learning of 2013, even for UPA, if you look into the end part of the UPA regime, Mr. Chidambaram came out with fiscal deficit reducing steps, a lot of it, just to ensure, because they understood the folly of going fiscally very loose. So fiscal prudence have structurally entered into our psyche. Even in this COVID pandemic, while our fiscal deficit went up, it went up by much lesser than if you compare with other emerging market economies, not to say about, compare them to other DM economies. So there also, while giving fiscal support, government was very much careful not to create a big demand shock in the economy like happened in maybe UK, US. It was mostly in terms of food grains. Government also came under a lot of criticism that they're not doing enough. But I think in hindsight, most people agree that it was right that they came out with a very moderate level of fiscal stimulus. So what I mean to say is that fiscally also, the policymakers are very clear that we don't want to create excessive demand. So the level of yield spike that we got in earlier times, either in 2013 or before, it mostly came either when we had big demand shock, which is not the case right now, or because we had some financial instability in terms of we had taper tantrum at that time. Currently, our macroeconomic backdrop is much different from those times. We already have an inflation targeting framework. So what inflation targeting framework does is that, it binds the market's expectation, it binds RBI's hands to ensure that they react quickly to inflation, which keeps inflation under control, and because of which actually long-term yields actually trend down. So early hawkishness by central banks ensures that you don't have to be that hawkish as you would have had to be late in the party. So because RBI already acted preemptively, And because fiscal is also very much careful to ensure that they don't give too much of demand stimulus. So what is the high fiscal stimulus that we are giving? It is basically food grains to the poor people, or trying to protect farmers from higher fertilizer costs. So none of this you can say is inflationary type of fiscal stimulus. So government has been very prudent. A lot of improvement has happened on the supply side. Plus, because RBI is tied to this inflation targeting framework, which means that it will be quick to react as it did, which will ensure that inflation doesn't go too high, which in turn will ensure that yields also don't go too high. Another thing is that in terms of the BOP level also, because we have over the last 2-3 years, RBI has accumulated around $280 billion of excess reserves. So they are easily freely using it in this current environment. And if you look into rupee performance, while it may appear that it has fallen against dollar, against most of the currencies, you compare the rupee performance against euro, you compare rupee against pound, you compare rupee against yen. Even if you compare rupee against gold, which is the ultimate anchor for a currency, rupee has actually appreciated. So what I mean to say is that the current backdrop is very much different from the earlier backdrops. So we don't, there is a possibility that because of high supply of government papers, higher fiscal, there may be some uptick in deals from these developers. We can't rule that out. But what we are suggesting is that the risks are such that the risk reward is such that it's a prudent time for investors to start allocating capital to such a strategy. As I just mentioned, we had this permission from SEBI even last year, but at that time we didn't believe that the risk reward is favorable to such a strategy, which we believe is now.
Sure. Thank you very much, Bhupesh. And now let's just shift the scope of this discussion a bit to the fund and to you, Harshil, now. Maybe I would like you to take us a bit in details through what is your, what is your thought about how do you want to manage this fund, your approach and your investment strategy. How would you manage the portfolio?
Yeah, sure, Medha. Just one. Yeah. So if you were looking at how our investment approach, like Bhupesh told, of why it's an opportune time for investors to come into this fund, from our investment approach, we're looking at basically 3 pillars. One is our core allocation is going to be primarily GSEC and SDL. The 2 things will generate alpha for investors. Of course, the core allocation we look at right now somewhere investing in 14-year GSEC, which is trading at about 25 basis points over 10-year. And if you go beyond 14-year, there is not enough spread available over there. So, and it is also a little lesser liquid than maybe 14-year GSEC. So we are preferring to stay over there right now, and a very small allocation to SDL as of now. Then, as we grow in time, and as we feel that there is an opportunity available for spreads, we will increase allocation to SDLs. So just to give you an idea, overall, if you look at a long-term tenor, your 10-year SDL versus 10-year GSEC has averaged at about 65 basis points of spread. Currently, that spread is about 40-45 basis points. So we would want to wait till at least go to this spread goes to about 60-65 basis points or maybe higher, and where our view builds that these spreads can compress, or this is giving enough additional accrual for investors. At that point in time, we will increase the allocation to SDLs. As of now, we will take a small portion of SDL and GSEC. Third part also is that we can also add some AAA PSU or corporate bonds, which are liquid in nature to this. But given that market dynamics have changed, since COVID times, there has not been enough supply of corporate bonds in the market. Once these, and of course liquidity was high, we have already seen that incremental credit deposit ratio is already above 1, which means that liquidity conditions are tightening. There will be more supply into this in this space of corporate bonds, and the spreads can expand. Right now, corporate bonds are trading almost flat or sometimes even lower than SDLs. So it doesn't make sense to allocate to corporate bonds in the long tenor space. So once these spreads also expand, we will look to tactically. So from the core allocation, you get your accrual. From your tactical allocation, we will get additional spread, which is additional accrual, or chances, which windows of opening up of mark-to-market gains because of spread contraction. And the third piece that we are looking at is active duration management. SEBI mandates that this fund should be at about minimum 7 years Macaulay duration. So whenever our view on interest rate changes and we feel that, this is the peak, or this is where, from here you can see a rally, because right now what we are saying is that long end bonds might not go up that much. But what we are saying is that, it is not also going to rally very hurriedly. So when the view happens that, we feel that these bonds can rally and these yields can come down further from here on a bigger move, that is when we will do an active duration management of maybe increasing the duration from 7 year to 15 year. In that range, we'll move. So our tactical allocation and active duration management will generate alpha for investors, whereas the core portfolio continues to generate accrual for investors. That's the broad investment approach and strategy that we are taking for this fund.
Sure, Harshil. So, based on the parameter and the structure that you just defined, how would you like to compare this product, or compared to the similar propositions in the longer end that we have? So there, we have a pure gilt sort of a proposition in the market. We have some propositions on the passive side also. Of course, there's a duration difference there, and I know you'll come to that. But yet, for an investor who's willing to, take a duration bet, there are a couple of, investment avenues that he has. And how is this positioned?
Yeah, so maybe we can compare both traditional savings, whereas also our existing offerings. So from a traditional savings fund, you have your tax-free bonds, which are available in the market, long-term fixed deposit, PPF. Each one of them, if you compare, from a tax-free bond perspective, the yields that are on offer right now, or the last traded yields, are pretty much lower, from where one will see maybe a GSEC yield. Fixed deposits also, we have seen that, how the if you look at this chart, this gives you a good idea of, this is the SBI 3-year FD rate, which should have taken from SBI's website. The spread over 14 years GSEC to 3-year FD rate is at its highest. We've also given a good comparison of how PSU FD rates and 10-year GSEC, 14-year GSEC and 10-year SDLs are. So it's quite evident of what's kind of a superior returning in terms of yield. Of course, there is a mark-to-market risk in this product, FD doesn't have. But in our view, the higher accrual compensates for the mark-to-market risk, and there is a 99% chance that you will always beat this FD return, which is also seen in a historical performance. If you see this chart and the dotted line, the dotted line is the 14-year GSEC performance versus the FD performance. Even when, yields have risen so much, you would have still beaten FD returns at that point in time. So, it makes case for versus conservative debt instruments, at least, and also from a taxability perspective, this is more efficient than your FD. PPF, etc., again, has a maximum limit of 1.5 lakhs in a year. And there is a lock-in, right? An option to withdraw money at any given point in time is very valuable. Any exigency can take up for a family, or maybe if you feel that you would want to shift to equity at a point in time, or you think you've made duration gains and yields have come down and take that exit. That also option is available. So that's a very valuable option for anyone, that your money is allocated for long duration, but you have that flexibility to remove at any point. So without any exit load that we are saying. So that's from a conservative debt instrument point of view. From overall all funds point of view that we have an offering, so gilt would generally range between 3 to 6 year kind of duration. So over here you are having 7 to 15 year kind of duration. So the potential to generate alpha wide MTM for somebody in a long duration fund versus a gilt or income fund can be larger. Income fund takes more of corporate bond, etc. Over here also we have that option, but in a gilt fund you are limited to a GSEC plus SDL. So it's not that these funds won't work well. So for a lower duration, for somebody who wants to stay invested for maybe like a 2-3 year period and wants to invest, maybe a gilt or income is better. But somebody who has 5 year plus kind of money, or in that 4 year 5 year kind of money, then long term fund makes sense. Also, in terms of passives versus gilt versus this, the kind of investor, because this is your core allocation, this is for your future goals, maybe certain goals, retirement goals, or maybe you wanting a continuous compounder, or avoid reinvestment risk, you would want to invest in this fund versus in your passive funds, where the kind of investor that would be there would be different. There is also a difference that you are targeting very different curves, right? In a passive fund we have 25, 26, 27 maturity. Over here you are targeting like a 35, 36, 2035, 2036 kind of maturity. So curve is completely different, when you are seeing a passive versus this. Also, of course, with additional volatility, there is chance for you to generate alpha over here versus what your target maturity fund of maybe a 26 and 27 can generate over here. Lastly, the 26, the target maturity funds, of course, are an opportunity right now. So somebody who doesn't want that volatility and maybe they can invest over there, but there is a limited time window of opportunity. You have reinvestment risk over there. Because your fiscal supply is higher, your GSEC yields are higher, the curve is steep, so you are being able to invest over there. And of course, passive versus this, your YTM would be higher than what a passive fund will deliver over here. So that's the broad difference between both of them.
Sure, that's quite useful, Harshil. And we have a couple of questions, piling up actually. So before I start taking them up, one last question from my side. The papers or the instruments that we are mentioning that we would invest in is, of course, sovereign bonds, STLs, and corporate bonds, both from PSUs and PSU bonds. Now, within this, what I want to understand, and for the benefit of everybody, is what are the points of similarity or dissimilarity between a central government bond and an STL? Now, one is issued by state, one is issued by central government. So would you like to elaborate on that?
Yeah, so of course, both issuers are different, but maybe, as you must be aware that RBI is the debt manager for both of them, and RBI is also our central bank. If one goes to RBI is the FAQs on government securities, there is very clearly given on RBI website that gilts or government securities as a whole is defined as state plus central government issued securities. So there is no differentiation between center and state. Both are called gilt. So for both of being termed as gilt. Secondly, within the states also, RBI has not differentiated anything. And RBI says that center plus state is gilt, and gilts are also called as risk-free instruments which carry practically no risk of default. So both center and state from a credit risk perspective are similar. Now that there is a pricing difference in both of them, there is a reason because of that, because there are various states, they are scattered. So there are a lot of issuances within each state. So, each ISIN might not have that much liquidity as of a GSEC. But if you put in pecking order of liquidity, there is the GSEC, which is issued by central government, then there is state government, and then there is corporate bond. So that is a larger liquidity difference. But even from an SLR eligibility, which is the SLR that banks need to maintain as a percentage of the NDTL, these state government securities also form a part of that. And there is free borrowing available by RBI against center and state government securities both. So there is no differentiation as such between both of them. So the difference that I would say is that there is, of course, a difference of yield which is available over there. Of late, center has been compensating the states for GST compensation. So for that reason, state supply has been lesser, which is why spreads are higher. Now that state compensation, the GST compensation might stop for states, you might see that spreads, once the supply goes higher, can increase from here. And of course, when liquidity tightens also, you see these spreads go higher, which is where the tactical allocation for our fund comes into play. So just to summarize, GSEC is center plus state. And second, that there is no differentiation between states that RBI does. But from our level, from what market perceives, or there are some states which are perceived to be inferior than others, which is perceived difference, of course, because of their fiscal imbalance, etc. Because center has a control on states of how much borrowing that each state can do, and before any borrowing that state does, center takes it needs center's approval. So for that reason, there should be actually ideally no differentiation between states, but some states have a weaker finances than the other. So we try and avoid some of them, and we try and take only liquid states across the portfolio. Even if we take the other states, will be in very small quantum and not much higher.
Sure, Harshil. So now maybe we'll begin to take up questions that are posted in the Q&A box. So the first question that we have here is, should we wait for the 10-year rate to harden further, or we can invest in this fund now?
Yeah. So like Bhupesh mentioned, and we have this chart clearly says that your rate hikes which are being priced by RBI already priced in. So you see that your policy rate, if you see the chart on the left hand side, is currently 490, which is the repo rate. Over next 1 year, you are reaching 680 as per market expectations of the OIS curve. So you are already pricing in that rates will go up by 190 basis points from here. And like Bhupesh also mentioned that there is a spread of 14-year GSEC to repo on an average, which has been about 120, 140. You are already pricing in 640, 650 kind of repo over there. So, and the third point being that if you don't invest right now, you would also need to calculate the opportunity lost of the higher carry that you are earning, right? Because let's say if you are investing in a 14-year GSEC, you would be at 763, 764 on a semi-annual, 775 on an annualized basis, versus let's say if you would park it in FD or some other instrument at let's say 6%, you are still having 175 basis points of negative carry, right? Which will make up for any loss that you would make if yields were to go higher. If RBI goes even more overboard than what is being priced in the market. So it makes sense for people to start investing and allocating right now and not wait for rates to harden further from here. And the other question that the same gentleman asked is about money deployed at one go in the fund. No, I think from our perspective, once we get the funds, money will be deployed at one go, and we are not looking to stagger the money deployment which is going to happen.
Sure, Harshil. So there's one question by Mr. Krishna Chaitanya that, sir, can you please repeat the thumb rule that you shared while calculating 190 bips rate hike by the market?
So thumb rule is essentially, this is the chart. What I am saying is your policy rate is 490. Now you have the OIS curve, which is the overnight index swap curve, which we use, or maybe a funding curve. Let's say, you take your 1 year NABARD bond, which is a PSU, or maybe a 1 year GSEC kind of thing. You will see that they are trading much higher. So the curve is very steep. By looking at these curves and calculating the forward rates, you can see that market is saying that RBI will hike rates by this much. So what this chart is being made for investors awareness is that market is saying that RBI might hike rates by 190 basis points, which is already in the price. So the thumb rule is that if RBI does more than this, then the OIS curve or this curve can get affected higher. If it does less, then there is a window for MTM gains to be made for investors, which we've been saying that as a team we think that the repo rate will be in the range of 6.25 to 6.5, whilst market is pricing in 680, so that there is room for some mark to market gains to be made over here.
Sure, Harshil. So the next question, I know you've touched on target maturity funds and its suitability as well. But looking at the question that we have, where a view on target maturity funds is sought, and is the right time to invest in it? Is it the right time to invest in it? Can they become the part of core portfolio for investors? And do short duration funds make more sense? So maybe, Harshil, you could throw light a bit on the sort of investor suitability for short-term funds, relatively longer duration funds, and target maturity funds. So yeah, maybe that's the sort of positioning that is being looked at.
Yeah. So as I discussed, target maturity funds will reach a particular target. Both are very different in nature. Let's say if you're a very long-term investor and you would want to invest in a fund versus a target maturity fund and a long duration fund, there is room for a fund manager over here, because it is actively managed, to manage the alpha by doing tactical allocation of spread management and duration management between three instruments: GSEC, SDL, and corporate bonds, which your passive fund will not be able to do, because in the index, you are saying that, this is the index, this is what you invest and forget. So it is invest and forget strategy versus one is for a set of investors who want to earn some alpha by doing that, plus earning the accrual of a high duration fund. So it's all about the little higher risk appetite that you get versus, the alpha that you will get by taking a little higher risk. Index funds also are good, they are not bad, and it makes sense to invest either in an index fund or in an active duration strategy, long duration strategy like this one. So both will be different. But of course, what the other narrative that we are saying is, because there is a recession risk which is looming around because of growth slowing down, and high frequency indicators, as Bhupesh mentioned, are pointing towards that, inflation cooling down, the chances or the opening up of long end yields coming down increases more than short end yields going down. So a passive fund will be a buy and hold strategy, whereas investing in an active duration fund at this point will be a tactical strategy for somebody to allocate who is a long-term debt investor. So that's the large difference of how one should look at.
Sure. So there's one question on how do we compare this against Bharat bond? Harshil, you're on mute in case you're saying something.
So Bharat bond, of course, is the government bonds where the underlying is invested in corporate bonds. We've shared our view on the corporate bond spreads, because corporate bonds are available right now at almost equivalent to SDL levels. So we as a team would want to shy away from investing in long tenor corporate bonds right now, given that you're not getting any spread over there. Plus a Bharat bond, again, as I said, is a index fund. It is a buy and hold strategy. So if it's a 10-year 2032 or 33 kind of a Bharat bond index, then you are locking in yourself in the 10-year curve right now. Over here, you are getting some additional accrual because you are going to be little higher than 10-year, and we will have the option to increase duration whenever we feel rates will come down. So that's the last thing. And over here, the spread management or the tactical allocation will be actively managed, versus in a Bharat bond, it will be the index. And given that as a team view, we feel that corporate bond spreads are not in existence right now, and we would want to shy away from investing in corporate bonds.
Sure. Okay, Harshil. So there's one more question from Mr. Soumya Sainarayanan. For the duration of 3 to 5 years, won't the investment made in low or short duration funds give similar returns and MTM gains as can be seen? So MTM gains can be seen in them too if rate cuts happen, and the shorter modified duration will take care of rising yields.
Yeah, I mean, by definition, So by definition itself, when for funds, where duration is higher, like this strategy, if the rate hike is actually less than what is already in the price, or if we outright get rate cuts, as the questioner is asking, then the gain that you'll be getting in this strategy is going to be significantly higher than the gain that you'll be getting in a shorter duration fund. So I don't think it is comparable. If RBI if RBI's rate action is lesser than what is in the price, then this strategy will most likely outperform most of the shorter duration funds, simply because the duration itself is very high.
Sure. So I think these are the questions that we have. So thank you very much, Bhupesh and Harshil, for having this detailed discussions. Maybe, if you, any of y'all want to just share your closing remarks before, we can conclude the discussion.
Yeah. No, just to summarize for investors, long duration fund from a overall perspective looks right now good, because we see that growth drawdowns are happening because of steeper rate hikes by central banks, as and when liquidity gets tightened, which we feel in which will happen in October. RBI can start doing OMOs, which will support the supply side, and given that there is tailwinds in the forms of growth being drawn down, inflation signs of cooling down, we can see that long end mediums can generate some returns for investors. And of course, the curve being very steep, it makes sense to capture the term spreads, which the fund is will be doing. And from a overall alpha generation strategy, we are looking at tactically managing the allocation between various instruments to gain benefit of spreads, which would be moved up or down, or managing and or managing duration actively by actively modulating duration between 7 to 15 years. So for all long-term debt investors, this fund makes a very good proposition right now to start allocating capital, and one should have this fund in this portfolio as a recommendation on the debt side from our team. And we look forward to support from all the distributors on the call, and thank you for taking out your precious time to attend this call and understanding our fund.
Yes, thank you very much, Harshil and Bhupesh, for actively sharing your views and answering the questions. And thank you very much all the participants for taking out time to attend this call. If you have any further queries with regards to the product or the proposition, please feel free to reach out maybe through your relationship managers to us, and we'll be happy to support you with any other additional information that you may be looking at. So have a nice evening ahead. Thank you very much.